Hello, welcome to the U.S. market analysis for today, Wednesday, the 16th of December. Today, we're going to be talking about the Federal Open Market Committee, the FOMC, basically the Fed minutes, because today they're supposed to be releasing the information that, the expectation that they're going to raise interest rates, and so. There's some reasoning behind why they decide that they want to raise interest rates for the first time in almost a decade, and a lot of it has to do with the current state of the economy, basically the inflation rate and also the unemployment rate. So. One of the reasons that people think that it's going to be okay to raise the interest rates is because our unemployment rate is around 5%, which is the sign of a healthy economy. But there are also those who say, for example, that just because the unemployment rate is at 5% doesn't necessarily mean that we are. It doesn't mean that we have it's not exactly a sign of a healthy economy, because you also have to look at the labor force participation rate, which is the lowest it's been in 38 years. So the difference between the labor force participation rate and the unemployment rate is that the unemployment rate doesn't take into account people that have given up looking for jobs. While on the other hand, the labor force participation rate takes all the people who are in the labor force, which is people who are currently working or people that are currently looking for a job. Those are the people that are in the labor force, and measures them against the people that have given up. Or it takes the labor force and measures that against the entire U.S. population as a whole, minus people that have gone to prison. And so the labor force participation rate is 62.4%. Like I said, it's the lowest it's been in 38 years. And so this is one of the reasons, this is one of the cons that people are saying to the interest rate hike, to people's reasoning that we're in a healthy economy now and it's time to start raising the rates. So why do people why does the Fed want to raise the rates in the first place? What is the good that can come out of raising the rates? And one of the good things that can come out of raising rates is that it can help bring us to a healthy inflation rate. So right now, I just looked up on the U.S. inflation calculator, and it said that we're at 0.5% inflation, and our goal for a healthy economy is about 2% inflation. And so just to give you an idea, our 0.5% is for the year, and that's down from 0.8% last year in 2014. And I think 1.3 or 1.4% in 2013. So it's relatively low, and people are worried that it could slip backwards into deflation. So one of the reasons that basically people want to increase the interest rates now is because that monetary policy, which is also raising interest rates, it takes time to actually have an effect on the economy. And so you could raise interest rates and then maybe you'll get the desired effects a couple months later. So that's why the Fed actually wants to increase the rates now, as opposed to when the inflation actually reaches 2%, because then by then it'll require fairly drastic interest rates increase, and that could have a negative impact on the economy. So what they're trying to do now is they're one of the things that the Fed is trying to do is they're saying that a subtle raise in rates now will be better for the economy than a drastic rate increase in the near future. So that's one of their pros for increasing the inflation rate now. And they also were promising that they're only going to increase the inflation rate at maybe 0.25% every 2 months, which is less than they did last time, which I believe was 0.25% every month. So hopefully the rate at which they increase the interest rate won't be as drastic and won't have as negative of an impact on the economy. So one of the reasons basically also that that they want to also increase rates is that because right now, if rates remain at zero for a longer period of time, it's already been almost a decade, so it's kind of difficult to imagine it being a longer period of time than that. But if they if they leave it at zero for another year or two, they're worried that that it'll create another bubble, because with interest rates at 0%, it encourages speculation, and it increases the price of financial assets. So that in itself, it creates a little bit of a bubble, and so the Fed is worried about having a bubble that will then pop, which will be similar to the same exact housing bubble, or not necessarily housing bubble, but any sort of bubble that we've had in the past. I just said housing bubble because that's what happened in 2007, but there was the dot-com bubble in 2000. So there's just a couple of examples of different bubbles that they're trying to avoid. To go back to the cons, to the negative aspects of increasing the rates. One of the things that people are worried about is that basically the world economy is not strong enough, because GDP was revised downwards recently. I think China just came out with a report today. I haven't had the chance to check it out yet, and also because recently other central banks have tried to increase rates since the crisis, and they've been forced to rethink their options. They've been kind of forced to maybe change that back a little bit, because it's getting drastic. For example, one of the things people are worried about would be like a Japan-style deflation. So people are saying that a slight surplus of inflation, which means that like going a little bit over the 2% mark, whatever that may be, between 2% and 3%, or 2% and 2.5%, is better than having a Japanese-style deflation. So it'll be interesting to see what the Fed does with the interest rates today, and I hope that you get the chance to use TRDR.tv, and I hope that you enjoyed my U.S. market analysis today, which is mostly talking about the FOMC, or the Fed meeting, the Fed meeting that should give their results today. So thank you for joining me. Have a nice day, and good luck.